Right. So today being day 15, I'll be covering about, I'll be introducing top-down analysis, and I'll be using this simple diagram because this will guide us, or this will give us the clear picture that of how we'll be doing the top-down analysis when we dive into the real chart. Right. So without further ado, let me start. Right. So we all know that there are a lot of time frames. Like generally, there is the daily, the 4 hour, the 1 hour, the 15, the 5 minute, the 3 minute, the 1 minute. All of these are, even the seconds and the ticks. All of these are time frames. But now the question that people ask is, which time frame should I use, or where should I start to make, or to mark the top down analysis, or what higher time frame should I use? But that is actually a personal question because it depends with with oneself. Like if you have like a busy schedule, that means that you will need the the swinging type. So this means that you'll be having like, you will be needing the higher time frames, like 4 hour, the daily and stuff, so that you mean like you don't need much of the management and stuff. And if you have like, you are a student and you have some time, or maybe you are someone who can access your laptop or can access your gadgets, or whatever gadget you're using to trade, if you can access them like anytime and all of that, then you can be a day trader, you can be a scalper. That means now you'll be looking forward for the lower time frames, like the 15 minutes, the 5 minutes, yeah, and the 1 minute. So it actually depends with you. But now the top down analysis, because all right, after you have identified the time frame for you, so someone else would have picked 4 hour as the higher time frame. So this means that the 15 minute would be the lower time frame. So this is actually the time frame selection. You can see the higher time frame exactly right here. You can see this is the higher time frame, and this one here is the lower time frame. So if you pick the daily, of course now this is upon you to choose, like according to your schedules and stuff. If you can manage a daily time frame, that is, you are busy with let's say job or school, and you cannot like have much, or you cannot have like a long period of screen time. So that means that I will just be checking and you know just just checking the screen, but you cannot like sit there and manage all of that. So that's when now you'll need these higher time frames like the daily, and of course now your lower time frame will be the H1. We will be covering like how we like how this high time frame and the lower time frame are connected during top-down analysis. If you're using the H4, you will need the M15 to be your lower time frame or your entry time frame. If you're using the H1, you'll be using the M5. If you're using the M15, you'll be using the M3. And if you're using the M5, you'll be using the M1. Anyway, this is just the recommended the recommended top down of two time frames. But there are times when let's say if you're using the daily, you may find like a good, like price may be clearer on the H4. If you're using the H4, price may be clearer on the H1. Of course, if you're using the H1, price may be clearer on the lower time frame on the M15. Let's say on the M5, price is noisier, or let's say the H1 structure is bigger, such a way that it looks the same as the H4. So meaning it's actually maintaining the same trading range as the H4. So this wouldn't hurt if you use the M15 while actually having the H1 as your higher time frame. But those are rare scenarios. The general recommended view is just daily H1, the H4, M15. But just know that sometimes you may need to, know when now to not use this lower time frame and pick something that is higher above it. Yeah, something like that. And the reason as to I'm saying this is because these, if you check the factors of these trends, I mean the factors of these time frames, this daily to H1, that's something like 24. H4 to M15, that's something like, I don't know if it's 16. This H1 to M5 is 12. M15 to M3 it's 5. So you can see the factor, it's very like it's ranging. So yeah, that's why. But this is actually the general view, and this is the recommended one. Like this is the one that is mostly used, right? So after that, like I said, I am not the one to tell you which time frame to choose. You are the one to know like your schedule and stuff, so that you know like which one will work for you. Maybe for someone like me, maybe you can have a lot of time, but you cannot manage the day, the lower time frames, because let's say you, all right, let's say that, all right, let's say you want your trades to last for like 2 to 3 days. Then this will it make sense for you to actually use the M15 and the M3, because if you're using the M15 and the M3, or the M5 and the M1, you should expect that your trade duration will be somewhere 30 minutes to a few hours. It will not be like a day, 2 days. No, it will obviously close within few hours. But if you now go on to the H1, the H4. This is where now, yeah, for the H1, of course, it will be something like a day. Sometimes it may even close during the day. So H1, yeah, a day or two, or even during the day. So let's start from the H4. Now from the H4, you should expect your trades to last for like a day. I know there are times it may close, whatever, but yeah, it can even extend towards a week, like a whole week. Yeah, you may also be looking forward to hold your trades overnight, holding your trades over the weekend, holding your trades over the news, because you have entered yesterday and today there is news and you cannot close the trade. Maybe because the trade is far away from your entry and the sell, or due to other factors. These are swing, whatever, they're not much affected with news, but not that I'm not saying that they are not affected, but not that much. But there are news that are actually stronger to, yeah, to invalidate everything. So yeah, so things like that are the ones that you need to consider before you actually choose a time frame. The reason as to why I'm saying this is because you only need to choose one. By that I mean, not today you're using the M5 and the M1, then tomorrow you decide to shift to the M15 or the M3. But let's say after a week or a month you're already in something else, let's say the H4 and the M15. I wouldn't recommend this. I would just recommend you to only pick one, H4 and the M15, H1 and the M5, depending with you, your personal view. What will you like your trades to last? If you would like your trades to close within the day, of course you should be looking from here. If you would like to hold your trades overnight, or to hold your trades in a number of days, maybe because you lack time to manage whatever and whatever, because now let's say there is news and you cannot like manage the trade. In that case, then you will need these higher time frames, because they are less affected with high impact news. So in that case, now you will be choosing that. So I personally, I am using the H4 and the M15, but I don't take the trade from the M15. I usually take the trade from the M5 all the way to the M1. So it's like a combination of this and this, or a combination of this and this. Yeah, because it's M15, then M3, or I can take it from the M5, or I can take it from the M1. It depends with the structure, how big the structure is, how noisier the price is on the lower time frames and stuff. All right, so I'm done with the time frames, and like I said, it's upon you to choose which time frame selection you want, but make sure that you only choose one and stick with it, and see, like, yeah, stick with it for a long period of time before you actually shift to the other. Right, so now let's dive into the rule work, the real structure. Of course, we know that we cannot shift to the lower time frame just randomly. We need to make sure that upon shifting to the lower time frame, the higher time frame POI is mitigated, or price has swept a liquidity level on our higher time frame. So now this, if your higher time frame is daily, your lower time frame will be the H1. So here you can see this here, I am representing this black color as the higher time frame, and this blue color as the lower time frame. So note that. So if I'm like, you can see this here, I have named this this line as the higher time frame, external liquidity. And if you notice, this is a bullish scenario because you can clearly see we are mitigating a bullish POI, and price after that you can see it's heading towards the higher time frame external liquidity. So you can see price is bullish. So this is a bullish scenario, and whatever we talk here or whatever we'll be covering here is the same or it's applicable in the bearish scenario. Right, so right here, like I said, we need a key area first on the higher time frame. Price needs to interact with the key area. By that, then it means a mitigation. By a key area, like we have talked before, we talked about the entry modules. You all remember them: the decisional POI mitigation, the extreme POI mitigation. And by POI, it can either be an order flow or an order block. We all know that it just depends with what the trading range gives. And of course, now the liquidity levels, which is either the inducement or the engineering liquidity. The abbreviation for engineering liquidity is ENG LQD. I didn't add it here, but I believe like you all know the abbreviation. For inducement it's IDM, and for the engineering liquidity it's ENG, then space LQD. It now depends with you if you'll be using caps or if you'll be using like the small case, I mean the lower case. Right, so right now here, when you see this, black zone, this represents a key area, and the key area can either be the ones that I've identified here or the ones that I have, the ones that I've mentioned here. And also this line is now a liquidity level, and of course a liquidity level can either be these ones because we say these are the core liquidity or the core IRLs. By IRL I mean internal range liquidity. All right, so price can either sweep an internal range liquidity, a core internal range liquidity. In that case, it's either the inducement or the engineering liquidity, and or the key area mitigation. So this black zone presents a key area, and if it's not a key area mitigation, then it's obviously a liquidity level sweep. So that's the reason as to why I have included both. And this is, if you have noticed, this is actually the entry modules that I showcased before. And in that case, when I was showcasing the entry modules, we were using the direct entries based on reversal patterns. But in this case now, we'll be diving into the lower time frame execution. All right, so exactly right here, we can clearly see, price has interacted with it. Alright, so price has either swept the liquidity level or mitigated the key area. Alright, so once price has done that immediately, or once price has done that on the higher time frame, now that's when you dive or you shift into the lower time frame. So once you shift in the lower time frame, what are you looking? It's obviously a change of character that will give you the possible sign that price is actually reversing. So the change of character in this case, it will not be like the way we have been marking market structure. In this case, it will be in a different. Alright, let me showcase how it will be. So when you shift into the lower time frame, of course, you need to identify the, the trading range. I mean, you need to identify the trading range, the current trading range on that lower time frame. Or sometimes you may not even want to do that because, like, it actually depends also with how structure is. But it's good to actually identify the trading range on the lower time frame so that you know which exactly is the inducement. So exactly right here, when you shift to the lower time frame, you can clearly see price has taken out the inducement. Look, I'm using these lines, but on your side, just know that these lines, I'm using them as price, or another name, like let's say a line chart. So price has taken out the inducement. Then after that, we all know that this one here will now be a confirmed swing point in such a way that if price now reverses and breaks past this, then that will be a bearish break of structure. So right here, price has broke structure to the downside, and this one here was the inducement, but then price created another inducement, and so we shift to the next because we say this need to be the recent formed pullback. And of course, this buy side liquidity is what we call the inducement. So once price breaks past this zone, then that will be the change of character. And remember, this here is the lower time frame inducement, but in this case, it changes its role from being an inducement to being a change of character. And by the way, that happens right after price has mitigated the higher time frame POI. If price has not done that, then that cannot change its role. It only changes its role from being an inducement to being a change of character after price has mitigated a key area or has swept the liquidity level on the higher time frame. So once that happens, you just mark this one here as a coach. So this means that this one here and this one here, they are all same points. And of course, this one here after price has made that break of structure. Then after that, everything now just is the same like everywhere until price achieves the higher time frame external liquidity. You'll just be trading normally as you usually do, using the direct entries, that is, but using this time frame, that is the M15. So right here, I'm just assuming that the higher time frame is the 4 hour. So this means this one here will be the M15. I'm used to this because this is the one that I've been using, the H4 on the M15. So yeah, so exactly right here, I say the inducement will change its role. And so after that, then the process actually is the same. After that, you should wait for the inducement to be taken out so that you can confirm your swing point. And of course, the inducement is obviously the recently formed valid pullback low, that liquidity, that sell side liquidity in that case, because they are bullish. So this one here will be the inducement. And once the inducement is taken out, of course, we know that's when now we start marking the POIs. And if it's a sweep, we all know that the inducement sweep is an entry module and you can take your buy from there. If let's say now it's not a sweep and price makes a liquidity run past it, then this means that price is looking forward to mitigate or is looking forward for more sell side liquidity. So then price takes out this low and then mitigates the higher time frame POI. In this case, it's an order block. All right, so this here is an order flow. So in this case, if you were to set a buy limit order, you would have set it from this order flow. But let's say there was no any order flow. This means you'll be looking forward to mark the the order blocks. So right here you can clearly see this here was the order flow. So right here price would have just if you were to set the buy limit order, you would have set it from here, and obviously you'll be targeting the higher time frame external liquidity. But if you would want a reversal pattern from this, because we showcased these scenarios where price, or we showcase the direct entries based on the same time frame, we usually use the reversal patterns. So after price has mitigated this area, you can wait for a reversal pattern, and once that reversal pattern is created, of course you will place that buy. But the most important thing, don't place your SL on the low of that reversal pattern. Place your stop loss at the low, at this low, or slightly below, and obviously now target that higher time frame POI. I know by doing by placing your SL below here, it will give you a good risk to reward, but like we know, or like we showcased like before, price can just fail that reversal pattern and decide to go down, create another one, so that now it can make that ultimate reversal. It can fail like 2 to 3 reversal patterns before you get that one that will make the ultimate reversal. It's just that you don't know. So why would you risk doing that? And you can still get a good risk to reward, or a reasonable risk to reward, if you just place your stop loss at the safer place and obviously target the external liquidity. I know in this case here it's actually a 5, but you can even spot like a 1:7, a 1:8. Yeah, so there is no need for you to actually want a 1:20, a 1:15, and you can still get a 1:7, a 1:8, but with a safer stop loss. Yeah, so that's something that we all need to practice. Like we should obviously, like, always be conservative. Like be aggressive. Like if you be aggressive, you will lower your win rate, And I know, of course, that may be psychologically messing to some of you, because when you see like your win rate is low, you may be like, this strategy is not working, or you may start doubting your analysis and all of that. But if you start being conservative, this means you'll be increasing your chances of winning, and this keeps your win rate at an average place, such that now the wins and losses, they are balancing themselves, and you are like, oh, all right, they are balancing, and in the long run there's a possibility that I will have, or will merge in positive, and that's what matters, of course, the long run. So yeah, things like that. I usually recommend doing things that will keep your psychology, I mean your trading psychology, intact, and being conservative by placing your stop loss at a safer area. That's something that obviously will keep your psychology intact, because yeah, you have placed your stop loss at a safer place. Of course, after price has done that, it has broke the structure. Now everything is good. Of course, you repeat the same. Price has taken out the inducement, and in this case there is no any order flow, so you'll be looking forward for the order block. So let's say the order block was somewhere here. Once price has mitigated that area, if you are looking for the reversal pattern, all right, you can do that, but make sure your stop loss is at this low, and do that. But you can see that there is no need for you to actually look for a reversal pattern, and you will be placing your stop loss right here. You can I usually recommend you placing a limit order, and of course placing now your SL at that safer place. There is no need for you to wait for a reversal pattern, and you will be setting your SL at the same area. But unless if you want to be aggressive, then you can do that. You can wait for the reversal pattern and place your SL below that reversal pattern. But like I said, this is not the conservative way of doing it. This is actually the aggressive way. I know it may work, but in the long run, I think you will be getting more stop out than price going onto your favor, and it's not worth it psychologically. So yeah, again, after that, of course, price creates the, you can clearly see break of structure. So you can see the break of structure to the upside. You can see now the process now, it's actually the one that we are used to. The only thing that was to be like, the only concern was from this, after the mitigation and shifting on the lower time frame, the inducement changes its role from being an inducement to the change of character. But after that, it's actually the normal trading. So you can see price broke the structure. This is the minor inducement. We said if it's the minor inducement, then the trading range low is what we call the external liquidity, as well as the major inducement. So if price reverses back and sweeps or grabs this major inducement, then that's okay. And yeah, we can take the entry. In fact, I usually like this kind of entries, because like the stop loss is tight, and at the same time it's safe, because you can see your stop loss is tight, and also it's safe because that's a major inducement sweep. And yeah, there is no any safer area than this. Of course, you need to place your sell at the low of this sweep. So once price has swept this external liquidity or this major inducement, and it has created a good reversal pattern, once that reversal pattern, or once that candle has closed, yeah, you place your entry exactly right there. In this case, I don't recommend placing your buy limit order. I know someone else will place a buy limit order on the major inducement and place a stop loss like this. You may never know. Sometimes price may wick like very huge, and we don't know the distance of that wick. So if you place something like that, assuming that price will just wick a little and reverse, then you may end up being stopped out. We don't predict here. We actually react. So in this case, then you will need to, not unless you actually place a bigger stop loss here, then that will be reasonable. But why should you do that? And maybe price may create a reversal pattern here and give you a good risk reward than the one that you have just extended your sell to whatever area you're guessing. So things like this actually do matter when trading. Yeah, and they actually define your overall profit, because someone may be too much aggressive, someone may be too much conservative. And if you be too much conservative, this means your profits will be less. If you be too much aggressive, also it depends. Sometimes price may go into your favor, and sometimes price may keep on stopping you out and stopping you out. And yeah, you all know what happens after that. So right here, after the major inducement is taken out, of course, stop loss below there, and target profit, of course, the higher time frame external liquidity. You can see the process of buying actually continues until the higher time frame external liquidity. So, and by the way, the profit taking is not a must for you to place to make it out to the higher time frame external liquidity. There are times where price, let's say you want your trade to end for, like, you don't want your trade to last for long, then in that case I'll just, yeah, you can have a rule for yourself, maybe a fixed risk to reward of 1:4. Then yeah, you can make that 1:4 and just take, even though you know that price will obviously extend obviously to the extra liquidity, but you just have a rule, a risk management rule, that you will only be taking a fixed RR of 1:4 no matter the case. So yeah, if the 1:4 is achieved, you are out of the trade, or maybe you will be targeting this lower time frame external liquidity, yeah, and also be doing that. It also depends with you, but obviously the final TP is the higher time frame external liquidity. Again, the process of buying, like I said, it should continue. So in this case, it's a minor inducement, right? So you can clearly see this here is the minor inducement, and this one here is let's say this is the extreme POI or the decisional POI. In this case, this is the minor inducement, so this means this one here is a major inducement. So in this case, if you are to set the limit order, now you will have to have a bigger stop loss, because you will need to extend below this area so that you may cater for that sweep in case price decides to reverse all the way, taking this taking this major inducement. Because like we said, we don't know if price will eventually react from this, and this here is a minor inducement. At least if this was a major inducement, then it will make sense for me to place my stop loss exactly at this low, and that you can see the stop loss of course will be reduced. It will not be like that large. But if this is a minor inducement, if you want to be conservative, then you will have to extend your stop loss some distance here below the major inducement, or the trading range low, of which is now the major inducement, like we discussed. If you see a minor inducement in a trading range. Anyways, someone else, the conservative ones, they will wait for a reversal pattern here and place their stop loss, of course, below the reversal pattern, and obviously target this area. So that's how, yeah, that's a conservative person. They don't care about the major and the minor. They don't care that the major inducement is more impactful and the minor inducement is more significant, as well as more less significant and less impactful. So this means the chances of it giving wins is low compared to trades that involving the major inducement. The chances of trades involving the major inducement providing you wins, it's high compared to the ones that involve the minor inducement. So things like this actually do matter when trading the lower time frame. And then after that, of course, the process, like I said, continues. So breakout structure, then in this case it's a major inducement, luckily, and also you can clearly see all of this area was an order flow. So of course you all know this is an order flow. The conservative person, of course, will just place the the buy limit order, stop loss, of course, at the low of that order flow, and target this higher time frame liquidity. If the risk to reward is favorable, it's worth it to take. If it's not favorable, then you should not take that trade, not unless you want to take it aggressive and wait for reversal pattern there. Stop loss below the reversal pattern and target this one here just to get that good risk to reward. So it's upon your decisions while doing this, but I usually recommend you to go with the conservative ways, as long as they give you also reasonable risk to reward. This will always make you psychologically good, and that means that in the long run you may find yourself having some profits than actually going aggressive, messing up with your psychology. And you know, if you mess up with your psychology, then your whole trading is done, because trading is a psychological game. So yeah, So today it was just an introduction and a logical or a theoretical explanation of how you will be going with this top-down analysis. The only the only thing would be was this one here. Like this was the only crucial thing. The after the higher time frame POI, the inducement on the lower time frame changes its role from being an inducement to being a change of character. And by the way, specifically the major inducement, I will recommend you to only use the major inducement. Yeah, only use the major inducement. Then after that, like I said, the process is actually the same. And up, like here now, it's upon you if you will be conservative, if you will be aggressive. But like I said, conservative will always set you good, will always make you less stressed. Like trading is already stressful by itself, so don't make it stressful by you actually being greedy for those massive risk to rewards. 1:20, 1:30. There is no need for those. Just have a reasonable risk to reward while placing your stop loss at a safer place. So guys, I will end the session here, and right now I am ready for any questions.